Gold is one of the oldest financial assets in human history. It has survived empires, wars, inflation, deflation, currency collapses, and technological revolutions. And yet, despite thousands of years of history, gold still confuses investors. Why does it sometimes soar to record highs? Why does it suddenly crash? And what economic forces actually drive its long-term cycles? In this video, we're going to break down why gold goes up, why gold goes down, the key macro variables that matter, how to think about future price targets using Fibonacci measured moves, and a 2026 case study that demonstrates how changing macro conditions shape gold's next move. This video stays useful over time because the ideas we discuss apply just as much in the future as they do today. Let's start with the basics. Gold doesn't move randomly. There are four major forces that consistently push gold higher across history. Inflation psychology. Gold often rises when people fear inflation, even if inflation isn't extremely high. It's not the number that matters, it's the loss of confidence in purchasing power. When people worry that their money will buy less in the future, they look for assets that hold value. Gold is one of the oldest answers to that problem. Government debt and fiscal stress. When governments run large deficits or accumulate unsustainable debt, investors begin to question long-term monetary discipline. Gold becomes a store of trust, a way to hedge against the possibility that governments may eventually inflate their way out of debt. Geopolitical instability. Gold thrives when the world feels uncertain. Wars, trade conflicts, currency disputes, political polarization, supply chain disruptions. Gold is one of the few assets that doesn't rely on any single government or financial system. Central bank buying. This is a major force in modern gold markets. Central banks, especially in emerging markets, have been steadily accumulating gold to diversify away from the US dollar and strengthen their long-term reserves. A standout example is China's central bank, which has been one of the most consistent buyers of gold in recent years. Their strategy is simple: reduce reliance on foreign currencies, build monetary resilience, and anchor confidence in their financial system. When a major economy like China keeps adding to its gold reserves month after month, it sends a powerful signal to the rest of the world. And here's why this matters. When central banks buy, they create a long-term floor under gold prices. They're not trading gold, they're storing it. They don't panic sell during volatility. They accumulate quietly, steadily, and with a multi-decade horizon. Put these forces together and you get a compelling narrative. Gold as protection, gold as insurance, gold as a hedge against uncertainty. But that's only half the story. Gold feels safe, but historically it has experienced some of the most violent crashes of any major asset. Example 1, the early 1980s crash. After a massive run-up driven by inflation fears and geopolitical tension, gold peaked in 1980 and then fell nearly 60% over the next few years. What's important here is the context. Inflation didn't suddenly disappear, and geopolitical risks didn't magically resolve. The real shift was monetary policy. When the Federal Reserve pushed real interest rates sharply higher to break inflation, gold's momentum collapsed. This period is a perfect example of how quickly sentiment can reverse when real yields rise. Number 2. The 2011 to 2015 decline. Gold hit record highs in 2011 during the European debt crisis and U.S. credit downgrade. But once the panic faded and the global economy stabilized, gold entered a long, grinding downturn, eventually dropping more than 45%. This wasn't a sudden crash, it was a slow bleed. As confidence returned and real yields gradually moved higher, gold lost its crisis premium. This shows that gold doesn't need a dramatic event to fall. Sometimes normalization alone is enough. Example 3. The 2013 meltdown. In 2013, gold fell about 30% in a single year, one of the sharpest declines in its modern history. The trigger was the Taper Tantrum, when the Federal Reserve signaled it would begin reducing quantitative easing. Real yields spiked, the dollar strengthened, and gold collapsed almost instantly. This episode highlights how sensitive gold can be to even expectations of tighter monetary policy. So what caused these crashes? It wasn't low inflation, it wasn't low debt, it wasn't peace and stability. The real driver was something far more powerful. Gold's biggest weakness isn't inflation, it's real interest rates adjusted for inflation. Gold pays no yield, so when investors can earn positive, meaningful real returns on bonds or cash, gold becomes less attractive. Historically, when real rates rise, gold struggles. When real rates fall or turn negative, gold thrives. This relationship is one of the most consistent in macroeconomics. And right now, we're seeing something important. Real interest rates have been fluctuating in a way that keeps investors on edge. In some periods, real yields have moved higher as inflation cools, creating headwinds for gold. In other moments, inflation expectations rise faster than nominal rates, pushing real yields lower and giving gold fresh momentum. In other words, the tug of war between inflation and interest rates is very active today, and gold is reacting to every shift. This is exactly why understanding real yields is essential for anyone trying to make sense of gold's behavior, not just today, but in any future cycle. Case study: the Volcker Era. In the early 1980s, the Federal Reserve raised real interest rates dramatically to break the back of runaway inflation. As borrowing costs surged and investors could suddenly earn high real returns on cash and bonds, gold collapsed. This period shows how quickly gold can fall when monetary policy becomes aggressively tight. Case study: the 2013 Taper Tantrum. In 2013, the Federal Reserve signaled it would begin reducing quantitative easing. Even before any actual tightening happened, real yields spiked simply because expectations changed. Gold entered a deep bear market almost immediately, demonstrating how sensitive it is to shifts in future policy, not just current conditions. This is the single most important concept for understanding gold. If you understand real interest rates, you understand gold. Let's use 2026, the year this video was made, as a case study. It's a simple example of how gold responds to shifting economic forces, and once you understand that, you can build your own view of where gold might head next. Gold is once again pushing toward record highs, and as always, excitement builds and headlines start calling it unstoppable. Inflation expectations are cooling. Long-term inflation expectations have been drifting lower as price pressures ease. Even though some categories remain sticky, the overall trend points toward normalization, reducing one of gold's strongest tailwinds. The economy is stabilizing. Growth has become more balanced. The labor market is cooling gradually, not collapsing, and recession fears have eased. A steadier economy naturally reduces demand for safe haven assets like gold. Real interest rates are quietly rising. As inflation cools faster than nominal rates fall, real yields have been firming. Positive real returns on cash and bonds make gold less competitive. The US dollar is strengthening. Supported by relatively strong US growth and higher real yields compared to other economies, the dollar has regained momentum. A stronger dollar typically puts downward pressure on gold. Crisis fear is fading. Markets have moved past the peak anxiety of recent years. While risks remain, the overall tone has shifted toward less bad, which historically softens gold demand. This combination doesn't guarantee a crash, but it increases risk. In a scenario like this, gold could experience a long consolidation, a 20 to 30% correction, or a multi-year sideways period. Not because gold is bad, but because the macro environment is shifting. This is exactly what happened in past cycles, and it's a pattern that can repeat in any future decade. Now let's talk about upside, because gold doesn't only crash, it also experiences powerful multi-year bull markets. For demonstration purposes, I'll be using GLD as the example gold ETF. You can use GLD or any other gold ETF you prefer. The analysis works the same. One of the simplest ways to estimate potential upside is the Fibonacci 100% measured move. This method is evergreen. It works in any decade. Here's how it works. Identify the previous major bull run. Measure its size. Apply that same magnitude to the current breakout. The 100% extension gives a potential price target. Using this method, the upside target for gold could be around $463, which is about 2.5%. This doesn't guarantee gold will reach that level, but it gives you a logical framework for thinking about long-term price potential. And if gold does approach a target like 463, you'll often see the market pause or consolidate. That's the moment to reassess. Do you stay in the position, reduce exposure, or wait for confirmation? The answer depends entirely on what price does next. If the chart begins forming a new leg higher, you can redraw your Fibonacci structure and project the next extension. If momentum stalls or reverses, that may signal a different phase of the cycle. The key is to let price action guide your next decision rather than the target itself. If you want to understand gold in 2026, 2030, or 2040, these are the variables that matter most. Real interest rates, the single most important driver. Inflation expectations, not actual inflation, expectations. US dollar strength, a strong dollar often pressures gold. Central bank buying, a major long-term support factor. Geopolitical risk, gold thrives when the world feels unstable. Fiscal stress and debt levels, high debt increases long-term gold demand. Investor sentiment, gold performs poorly when investors become complacent. These variables form a timeless framework, one that works in any decade. Gold works best as a hedge, a diversifier, a form of insurance. It works worst when investors treat it like a growth stock. The smartest approach isn't all in or all out. It's understanding why you own gold, what conditions support it, what conditions weaken it, and what signals would make you adjust your exposure. Gold doesn't rise forever. Gold doesn't crash randomly. Gold responds to confidence, real returns, and trust in the system. If you understand those forces, you can navigate gold markets in any era, whether it's 2026, 2036, or beyond. That's the end of today's breakdown. Tell me in the comments, what do you watch when analyzing gold? And before you go, I've also built an ETF portfolio that I track publicly. If you'd like to see how it's performing, you'll find the link down below. If this breakdown helped you understand gold more clearly, give the video a like and subscribe to FinEd for more macro insights without the noise. Thanks for watching, and I'll see you in the next one.